What is up, you guys? This is Evan from Relentless Society with a brand new video coming at you guys. How to become a breakout trader. In this video, you'll be learning what breakout trading is, levels, rejections, long and short positions. This is the secret what helps me grow in a trader, and now I'm going to share it with you guys. I hope you guys do like the video. Give a thumbs up, subscribe, and I'm going to go ahead and put a brief disclaimer on the screen, and we'll go ahead and get right into the video. So what is a breakout trader? A breakout trader is someone that trades breakouts, meaning when you have a level, per se your level is at like 39,500 of a resistance, and that candlestick rushes above it and keeps going up. That is a breakout. Now the best way to really pair that strategy or this strategy up is with a retest or a volatile market. When it comes down to that volatile market, you want to be very cautious about what you trade. Why do I say that? Because if it's really bad price action, it can just be really bad and you can get wrecked out by your stop loss. Now, looking at this strategy, a breakout trade is generally this right here, where you have that push, that big push up, your level right here. Let's say this is that 39,500 level, breaks above it, and then keeps going. So what is that retest? That retest is when it breaks above, comes back down, and your entry is going to be around here to all the way up here. All of this could be your entry. Now, with that being said, when you have that level, and then it breaks out, retest, and goes, your entry when you want that retest is that come back down and then keep going. Now, what do I mean by a volatile market? A volatile market is when the market is just like, it starts going insanely up or insanely down, but when it breaks out, you want it to be a good reason of breaking out, where it's like maybe a 930 candle where it's going to keep going sometimes, or a news candle where sometimes it might keep going. You want to be very cautious about it. So going back over here, breakout trading is something that you should always study. It's something that it's always gonna or should be studied a lot if you are wanting to go into this part and break it down so that you have a better understanding of how it even works. Don't just watch one video and then go straight into doing it. Like, no, take some time, study it, because it is something that I recommend look over. This is my own strategy where I use it myself and how it works for me. So continuing, some terms that we do use as traders, we have levels, an area where you use to see or notice where price has come to and rejected. More than likely, a lot of people, you'll see that they'll have that level when it's rejected like 3 times. So when we come over here, level right here. So I like to grab boxes. Boxes don't have to be exactly on point, but we could go like right here. See how we can tell that this is a level. This will be more, that's fine. We'll do this actually. Extend it to the right. Beautiful. So what that means is you see how it's tapped here, 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 as well here, and if we keep going, it kept tapping all of this. This means that that's a key level. In point in time, it's touched. Now let's go back and explain what that breakout level, looking at it like this. So that breakout leveling or trading is, see how we come up, we broke and kept going up. That small retest would be this right here, come down and then take off. Doesn't have to necessarily mean it touched, but it take off. Your main important thing is that break of this area. So your entry could be right here to then capture all of this. That's what a breakout structure is, or breakout trading. So retest is when you see that candle take off and then come back, test that area, and then keep going up. A lot of people like to say like liquidity is sitting there and a lot of like big buyers, whales and stuff will come grab it and take off. Rejection. A rejection is when the price takes a key support or resistance level but fails to break through, reversing in a direction instead. So let's go look over at retest and rejection as well. So that retest, like I said, so what do we have? We'll see thousands of retests, right? So we could go right here. We can do like a level right here because we had this position, this rejection here. Once we took off, guess what? We came back and retest. Even when we had a big move, let's say like right here, we took off, retested, took off, retested, took off, retested, and kept going. Those are all retests. Even on the downside, what we have here, we have a nice fall, retest coming back up, fall again, retest, and then a fall again. That's what a retest. Now, when we say rejection, what do we mean by rejection? Man, what is a rejection? So the best way that I can put it is all of these key levels. It's what makes a level, right? So you see how we came up, rejected it, came up, rejected it, came up and rejected it, and then kept going. That's what a rejection is. Now going back over here, we have a long position and a short position. What's the difference? The long position is the area where you enter or commit to that entry going for more high. Short position is the opposite. So it's the area where you're entering for the market to keep going down or looking for it to go down when you want it to go down. So what is that short position over here? So that long position, let's say we get in right here. That would be that long position. We're going to go like, let's just say there and then whatever. But this would be that long position. We want the market to keep going up. What is that short position? So that short position, and let's say I look at it, I'm like, okay, I want it to come back and test a level. So we do see that we have a level right here. And I want to see a retest above it. So we see, like, look at that. That's perfect. Breakout, retest, and continuation. So I say, okay, I'm gonna let it retest, but I'm gonna enter down here so I can make sure it goes in. That's that short position. Right there. There's that short position. Going back over here, volatility. When the area or time starts to move a lot, or is very risky to understand. So you want to understand your risk and understand where the market's even going. So what is volatile? Volatile is when the area starts to move a lot quicker and a lot riskier. So you want to be very careful with it and understand what risk you're playing with. So let's come over here. Let's go to a 5-minute area and about 9:30. Okay, so what we can see here is like that 9:30. See how we have one big candle but a big wick, and then one big candle and a big wick. So a lot of people right here would have gotten into longs and gotten stopped out because yes, we did break above, but then we fell completely down and continued to go down all of this. So that's a perfect example of a volatile market. We have boom, 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 and then a fall. So even if we go and look at yesterday, 9:30, see we have a nice big move, then a fall, big move, and then a fall. That's a great example. That is what a volatile market really is. So it means you want to be careful. Yeah, it's great. A breakout trade, I can find a good example. A breakout, boom, volatile, the volume's there. It kicks off and it keeps going. Broke your level and you get in, boom. That's great, but that's very risky. So a lot of people like to pair it up with a nice retest or fair value gap and different things that you may have. So when do I know to look for a breakout? So going back to where I had said about very high volatile area, so I would start to look at market openings or area of good volume, meaning a lot of people want to get in, areas like that. So 10 a.m., 9:30, news areas, stuff like that is going to have a very good volume kicking in where you can have a nice move up or a nice move down of a breakout. Now, always remember that breakout alone aren't bad because you can have a good opportunity from it. But myself, I like to really pair it up with a retest. So that position, I got a good feeling in it. And when I'm in it, I don't have to stress or even think or nothing like that. You know that strategy is a lot better with that. So I would 100% ask you to do a lot of research on it. Now, how do I know when it's volatile? Understand when the market is too volatile, it is critical for successful breakout trading. Breakout traders perform best in controlled, steady conditions rather than during an area of price action. Meaning, when it's very, very volatile, whereas, like I told you guys, you want to be careful. That's why you want to add a retest, a fair value gap, stuff like that, where that area is going to be a lot better. Volatile market will help you make a lot of money, but can help you lose a lot of money. So you want to be very careful when you want to look for that breakout area. You can identify excessive volatile when the market starts moving rapidly in one direction, only to quickly reverse and continue functioning unpredictable. Meaning that 9:30 is a very good time because there's times that the market just keeps taking off, but lately with the price action that we have been having, it hasn't been the best. So I would be very careful. I would want to wait until like at least 9:45, getting ready to that 10 area where we can have more of a nicer move, a clearer move, and see where that market is looking at or where that market wants to go, so have a better understanding. This kind of behavior is critical, and by inconsistency and choppy movement will really mess up that trade. Now coming back up here, how does a retest work? Or actually, let's go back and actually break down what that one is real quick, that volatile market. Let's see, what is this, 930? Okay, so at 930, see how we had that nice push up and then kept going up and then not rejected, but fell ultimately down? That's a volatile market. That means there's a lot of things going on and there's so many big wicks. See the big wick here, the big wick here. We see all of that. That's a very volatile market. So where's this area? Look at that. 10 o'clock, we had a nice move up, came back, retested it, and took off. See how that's a more nicer move? So your area, right, like right here, I would have like a candle right here. Look at that. Perfect. 10 a.m., we started watching, broke out, retested, and took off. That's what I mean by waiting into that area is a better moment to trade. Now, let's go over here. So now, how does retest work with breakout? So the market's going to break out, and it's going to push through your level. Now you want to wait for it to come back, test that level, and keep ripping to the breakout side. Then with that being meaning, that means, so if we come over here real quick, that means when we go look at this, when we go look at this example that I have for you guys here, this example that we have for you, see how initially our breakout was to the upside? So it's that retest and then go back to that initial breakout area, that upside move. Now, with that being said, it's good to pair it both because you're going to have a more control of that feeling that you have in your stomach. Oh man, is this trade not going to work out? Is this trade going to work out? That's going to be able to be more controlled because now you compare that and say, okay, I have more controllability. I like this move and it already tested my level, meaning it's not wanting to go back. It's going to keep moving to more ups. With that reset, with that retest, it's going to understand a well understanding of the market, okay, following the direction that it wanted to. Now, again, it is very important to have a risk to reward. I'm going to tell you straight up, risk to reward is the most important factor in trading, driving largely by affecting risk management. What does that mean? Okay, I'm not going to be the one to tell you, oh, trade 1% of your account, trade 2% of your account. If you're trading with $1,000, let's be completely honest here. Let's be completely honest. 1% of $1,000 is going to be like what, $10? You're not going to want to take $10 when you go home. That's not why you're even wanting to pick this route. So what would I personally do? It's, if I have $1,000 account, truth be told, call it what it is what it is. I'm going to risk $100 to try to make $200. That's going to be my strategy. Or even go by ticks. Know the market that you're trading. You don't have to trade YM or NQ. You could trade M and Y, M and Q. You can trade these things that are smaller market and make a better profit to reward about it. Go stick to your ticks and understand that, hey, let me not risk so much, but make a good percentage back. The whole point of trading is not how many trades you take. It's not, oh, I took 50 trades, but my profitability out of those 50 trades, I'm only up 5,000. No. It's taking that, I took 2 trades, I'm up 5,000. You risk, let's say, $1,000 for 2,500. That's a nice risk to reward. But you need to understand that that's going to be most important beyond anything in the trading world. Like I said, and I wrote it right here, personally, I prefer a 50 tick stop loss with 100 ticks take profit. Meaning, if I risk $500, then I'm going to take 1,000 home. You just have to be aligned to your comfortability. Understand what you want. Now the ticks. Ticks in the future market represents the smallest increments price movement that a future contract can make. Each future contract has a specific tick size and tick value, which are defined by the exchange. By understanding tick size and volume, traders can make an informed decision and make better management to their positions the future. Okay? And so this trade I took, very small trade, very quickly. I got in there in the breakout. Small retest on the, this was on the 5 minute, but I did it on the 1 minute. Had come back, test my level, and it came down for a nice 1 to 2. Very quick, took my profit home, went home. Now a really good other retest could be right here. See how we fell? This is my level. We fell, retested that level, came down. Didn't come completely down. We did retest again because that is a big candle, but we came retest it again and ultimately fell again. So that's what a retest is. That is what a breakout is. It's very simple for you to really understand. You don't want to complicate yourself. I put too many rules or put this, then you're just going to overdo it and it's going to mess your whole trading up in the long run. So going back over here, let's go over it real quickly. I really like that example. I'm not even going to move from there. So we have that market, came down, rejected from it. We ultimately wanted to fall because we could tell that we had this nice move to the downside. So we fell, retested, and then completely fell. Market makers, whales, big people that have more money than you and I have, wanted to go up. So they bought in, came up, retested that level that we had just made. It became its support area and started to go to the upside. So where would you enter? Would you enter, let's say, right here? Sorry. Would you enter right here, or right here? Give it a couple seconds. Now, if you did say you would enter right here, then you said perfect. That's exactly what I would do. So that's going to be another video here. We're going to go ahead and put an end to the video. I hope you guys did enjoy the video, got the information you needed. It's very simple information, so that way you can use it and go forward with it.